All right, welcome to Wealth Builders. My name is Anthony Cangemi, and we have our co-host with us this morning, our fabulous Tony Shore, who's with us every Sunday morning. We want to thank you so much for joining us. We have a great show today. It's an important show. We're going to be talking about things that we should be thinking about before the end of the year. But before we do, incidentally, as it relates to taxes, and so we want to primarily focus on items that should be considered before the end of the year as it relates to our tax planning. But before we get into that, let me just welcome our co-host, Tony Shore. Tony, thank you so much for joining us this morning.
Yeah, thank you, Anthony, for having me. Once again, it's always great to be on the show with you. I love it. And today is a great day, a beautiful Sunday, and we're going to talk about, year-end financial planning, retirement planning, mainly to do with taxes. That's what people need to be aware of, what they need to get done before the end of the year to make sure they have all their ducks in a row. So it's going to be a good one. I've had a great week. I've just been really busy, as you know, with family stuff. It's just crazy. Now we're headed into the holiday season. What have you been doing, Anthony? I know you're busy with the office there, with Crescent City Retirement Group and Financial. You've been meeting with clients, meeting with people, but also you always are busy with your family as well, aren't you?
Yeah, absolutely, Tony. Family is big for us, and certainly for our clients.
Yeah.
Yeah, I enjoy my boys. We do. Fishing is good right now, so we've been
Yeah.
enjoying that. It's interesting though. I have four boys, and really two out of the four love fishing. The other two hate fishing. So they're all different. We say this all the time, and we have four boys. They're all, same mom and dad, all grew up in the same, environment, and they are all four of them actually are just totally different. It's actually amazing. But they're great, and we love, spending time with them. And Tony, I tell you, family. The longer I am in this business, when we start talking about family and of course with financial planning, we talk a lot about legacy and legacy planning. And frankly, the older I get, the more important that is to me personally. I get it. You know, Maybe prior, I've always known it was important, but it's really becoming more personal to me
Hmm.
as my kids get older
Yeah.
and, just looking and thinking about estate planning and legacy planning and how things are going to go if I were to, transition out and to leave my family with, whatever assets they receive and the legacy that I'll leave behind. And
Yeah.
not only financial, but also, attitudes, thoughts, any wisdom that might have been acquired in my life over the years. So just all of that, as you know, is part of our legacy. And so it's becoming more and more important to me. And I know certainly it's important to our clients. But yeah, no, my family's doing great. How about you, Tony? How's your group over there in Minnesota?
Minnesota. Yeah. Well, Sarah and the kids are great. In fact, this weekend was busy because my daughter, she had a birthday, Allison, a week ago, and so she just now this weekend celebrated with her friends. So there were a group of 9 of them. They all came over to the house to see
Okay.
the cats. So she brought all her friends over, and then they went out downtown Stillwater. They went to an apple orchard and winery. So that was fun. And our daughter Anna was home. So we got to, and actually our son and his wife stopped by. So we got to see all 3 of our kids. And, as empty nesters, as these kids grow older and they leave the house, it's always fun to see them. Of course, I know you're with your whole family a lot because Your boys work with
They're
you
all still
there.
there. Yeah.
Yeah, and they're all still there. I think that's great. All three of ours are out of the house basically. Anna, our youngest, is still in college, so she comes home from time to time. But you'll cherish those moments once they all move out and get married and move out. Boy, it's sure nice to have them back. That's for
Uh-huh.
sure. Yeah, I love that. Now, today, I know we're talking about year-end financial things to do before year-end financially, and a lot of these mostly have to do with taxes. Most financial planning, unfortunately, has to center around taxes and taxation because you can make really costly mistakes if you don't have a plan in place and aren't paying attention to it, especially this time of year. Correct?
Yeah, absolutely, Tony. With financial planning, a lot of times we'll spend so much time on investments and returns and the stock market and the economy. And all of that obviously is very important.
Yeah.
But just, taking a blind eye to taxes and possibly overpaying or not taking advantage of the tax code or the tax situation that you might be in, and not utilizing some of the things that you have available to you to minimize your tax burden now or in the future is really it's really important, Tony, because at the end of the day you want to be tax efficient. You want to be tax efficient when you're accumulating wealth, and you certainly want to be tax efficient when you're distributing wealth. And so these some of these strategies and contributions and contribution limits and all these types of things end on December the 31st. So it's important to start thinking about, okay, what have we what do we have available to us, and what are we doing, and does it make sense to look at other thoughts and ideas about minimizing our taxes for 2025.
Yeah, and minimizing your tax burden is huge, and I know this is a big part of what you help your clients and people you meet with do. And I know you do educational workshops and do the radio show here to let people know how they can do this. You're not a CPA, you're not a tax preparer, but you do long-term tax planning and look at this for your clients and work with CPAs alongside tax professionals to make sure they don't make these costly mistakes. And I know a big one to make sure you want to max out your retirement contributions if you're still in that position where you're putting money into your retirement funds if you haven't yet retired. That's got to be a big one, right?
Oh, absolutely, Tony. So when you're making these contributions, whether you have a retirement plan, a 401k, or a 403b, or a 457 plan, depending on what type of retirement plan you have on the job, you have these contribution limits. And of course, every dollar you put in is a dollar that is deducted from your taxable income. And so folks a lot of times don't recognize what's available to them or what they can put in right now. For an example, you can put in for 2025, the limit is $23,500 that you're available to put into your 401k. And if you're over 50, there is the catch up provision where you can put up to $31,000 to your 401k. So if you're over 50, you can contribute up to $31,000. So that's a significant, if you will, dollar for dollar reduction on your taxable income. And then they even have now what's called for 25 the super catch up provision. If you're between the age of 60 and 63, you're able to put another $3,750. So a total of $34,750 if you're between the age of 60 and 63. And they call that the super catch up. So yeah, these are really, nice limits, Tony, to be
Yeah.
able to make these pre-tax contributions to your retirement plan.
Yeah, I mean, it's benefit. It's beneficial now because you get the tax break now. Plus, you can build up that retirement fund, which you always want to do. The more you put in, the more you save for retirement, the better. And you that way, the more you put in, the more you'll ensure you're going to get at least the full match, your employer match, right? That's free money, right?
Oh my goodness, yeah, Tony. I mean, it's been said that it's absolutely free money, and if you're not taking advantage of that, you're missing out on your employer match. Is literally like turning down a raise.
Yeah,
This is money that your employer is going to pay you up to a certain percentage, right?
yeah.
So understanding what that percentage is and making sure, let's say at the very least, that you're contributing enough to where you're receiving, if you will, the full match of your employer. A
Yeah.
100%.
Yeah. All right. Well, let's move on to another year-end item on the checklist. What else do we need to know about as the year end approaches? What else should we be looking at doing?
Yeah, Tony. So required minimum distribution. So if you are retired and you are 73 or older, then more than likely, and again, we have to look at date of birth. Some people's RMDs are required minimum distributions. They had to take it 70 and a half. Then they moved it to 73. Now, for some of our younger folks, it's 75. So, but recognize that if you are subject to required minimum distributions, that has to be completed by December 31st of this year. And this is important, Tony. Now, this is a distribution strategy whereby, at a point, and we're going to use 73 as an example here. If you're 73 and 73 is your RMD requirement, or older, then you have to take distributions from your retirement plan or you get penalized.
Hmm.
Let me say this, Tony. Just on the onset, everybody's situation is different as it relates to retirement planning, depending on your age, depending on your income, depending on your filing status, and many things go into calculations. But what I will say today, Tony, with the help of technology, we have platforms that literally read the tax return and offer all with today's tax code and today's tax um, again, the tax code, your filing status, and your situation, and actually reading the tax return and giving observations of the different things that can be done to minimize your tax burden. And so I'll say that we're not necessarily a lot smarter than we were years ago, but the tools that we have available to us certainly are a lot smarter. So for our clients, we're able to put their tax return into a pretty sophisticated tax software where the platform reads the tax return and puts out all the observations, Tony, of the things that can be done to help minimize taxes. And as you know, Tony, and we've said many times on our show, that quite a difference between tax planning and
Yes.
tax preparing.
Yes.
And so it's really important before the close of the year to be thinking about that tax planning. Once you receive all the year closes, and certainly you receive your tax forms, 1099s, W-2s, K-1s, or whatever it might be, and you go to your tax preparer, they're able to do a good job preparing the taxes. But really, the planning part happens long before that, before the year actually closes.
Interesting. Well, I know that you have to have strategies in place. I know you work with your clients to make sure that they have strategies for all the aspects that we're talking about today, like required minimum distributions or increasing what you put into your retirement accounts. I think that's really great. I mean, it can save you a good tax strategy can save you thousands, can it?
Oh, absolutely, Tony. It really can. And so making sure those RMDs are done properly, making sure that there's no penalties waiting on you on the other side, it's critical. And that's why we always say that really your investment strategy and your tax planning really have to talk to each other. It goes hand in hand. And to your point earlier, when we run these tax observations and these tax reports, we have CPAs that we work very closely with. And so if there's anything additional that's needed as it relates to our recommendations, we certainly have a great team, Tony, of CPAs that we work with to really offer the best advice that we can for our clients.
I think that's great. Now, before we go on, let our listeners know that number they can call, Anthony, to get a hold of you and set up a consultation to get a second opinion on where they're at with their financial plans or retirement income plans, or where they're at with their year-end planning, period.
Absolutely. So our number here at the office is area code 504-828-2171. That's Crescent City Retirement Group. Or you can go online to crescentcityretirement.com and just look us up and ask for a retirement ready consultation. We can spend 15-20 minutes on the phone just kind of talking through your situation and really just trying to offer the best advice that we can to help our clients and our radio listeners to have the most efficient tax strategy they can before the close of 2025.
Sure. And I know that in a lot of cases, you're really big on Roths and Roth conversions, and that's a big taxable situation. So if you have a low income year or taxes are low as they are now, that's something I just want to reiterate that Roths are something that our listeners should be aware of, that they might want to do some conversion to Roths, correct?
Oh, 100%, Tony. So once we're in retirement, especially, we're looking and, back to the tax software, we're looking at the bracket that our clients are in. When you get an inventory of your assets, you know that really there's three different tax implications of each type of account. You have a non-qualified account, which is after tax, a qualified account or a traditional IRA or a pre-tax account, and then, as you mentioned, Tony, a Roth. Well, the Roth IRAs, and now even they have Roth 401ks, but these Roth accounts, Tony, they are tax-free. Not only tax-free to us, but tax-free to our heirs. So it's real important to understand, how we can utilize our tax bracket in retirement to maximize these Roth conversions. Ultimately, any pre-tax money, qualified money that hasn't been taxed, is got to be taxed. And the question is, at what rate?
Yeah.
So we want to make sure that if you're in an efficient tax bracket, especially in retirement, and you still have room in that bracket before you would slip into the next bracket, we do a lot of those Roth conversions where we're just simply moving money from the traditional IRAs, get Uncle Sam out of the way, and then funding the Roth. Once that takes place, Uncle Sam's got his taxes on that money, and now in the Roth account, it grows forever and ever tax-free, not only for us, but for our heirs as well. Ed Slott, and I might have mentioned this before in one of our shows, but Ed Slott, who's really a advisor's advisor as it relates to taxes, but he wrote a book called The Tax Time Bomb, and talks a lot about Roths inside of his book. It's a New York Times, one of the best sellers. It's called The Tax Time Bomb by Ed Slott. And he makes the analogy, Tony, uses a farmer analogy, and talking about the Roths, and says, would you rather, as a farmer, would you rather pay taxes on the seed that you plant? So would you rather pay taxes on the seed or the harvest? And so I thought it was a good analogy. With the Roth, we're paying taxes up front with the initial contribution, but then the harvest, the interest, the dividends, all the growth is tax free. And so these Roths are really just tremendous financial tools.
Yeah. Well, and I can see that. So Roths are good. And then if you have stocks, there's tax loss harvesting. You might want to look at before the end of the year. Um, you don't want surprises in April, right? You want to make sure you're doing everything you can before then.
Oh, absolutely, Tony. I mean, you really are. And again, that's why your advisor or your investment firm has to have taxes on the radar for you, because ultimately, when the year closes, many of these opportunities end. And
Right.
so, so it really is important for your investment firm, your retirement firm, to be thinking about tax strategies for you, so you can really keep more of your money and let that work for you and your family for many, many years to come, and sometimes multiple generations to come, if it's done correctly.
Yeah, I think that's huge. So let's move on to the next item on the list that people might want to consider before the end of the year, or make sure they get done before the end of the year. And that's maybe charitable giving. Now, I know since people basically stopped itemizing in many cases because of the larger standard deduction, people don't itemize. But there are ways you can save money by giving still, aren't there? Talk about that, especially if you're a retiree.
Yeah, absolutely. So, yeah, to your point, Tony, and especially now with the big, beautiful bill, if you're married, filing joint, you have a pretty sizable standard deduction, depending on your age, 33, 34,000 as the standard deduction. And then with the big, beautiful bill, if your income is at the limit there, you get another 12,000. So,
Yeah.
conceivably, a married person, has over $40,000 of a standard deduction. So why that's important or relevant is we have a lot of clients that like to give. They give to the church or they give to charities, and then of course the money that they give, they would like to write that off of their income. But to your point, if they take the standard deduction, those gifts that they give are not, they would be tax deductible if they itemized. But if they take this, you don't get both, right? You can't take the standard deduction and itemize your giving. So to your
Yep.
point, most people take the standard deduction because they don't have that much in itemized deduction. So the giving that you give really is not helping you on your tax deductions or on your tax return. However, if you're giving to a charitable contribution and you are taking RMDs, or required minimum distributions, we know those RMDs are taxable, right? That's taxable income. It's on the income column of your tax return. That's the whole point of an RMD. The IRS wants you to take money out of these IRAs so you can pay your taxes. But if you do a charitable contribution, a QCD, charitable contribution distribution, where you're contributing to the charity directly from your IRA, it satisfies your RMD requirement, and that income does not hit your tax return. So you get the tax-free income to be able to send to the charity. So if you are taking RMDs and you do give to a charity, you're going to want to do those charitable, qualified charitable contributions.
Yeah. And this is
to your
something you can
charity.
help people with, right? And so like my parents used to just write a check a couple times a year, a fair size check. They used to tithe to their church.
Sure.
10% of their earnings they would give to the church every year. Well, they just wrote a check out of their checking account. That's money they had paid taxes on. They kept doing this when they were in their 70s after they were already they were having to take RMDs out and pay taxes on the RMDs. They could have
Correct.
just had, instead of writing a check to the church, had that amount direct transferred from their IRA to the church and not had to pay taxes on that money. And they would have saved money. The church would have gotten their non-taxable charitable donation, the same amount.
Absolutely.
And then you can even afford to give a little more that way if you wanted to up your contribution, because you're getting that break on it. So a lot of people do that, but a lot of people don't know about that or how to utilize that. So I think that's important to note. Now we only have a couple minutes left here. I know there's just a couple of other things. Is there anything else you want to add before we go?
Well, I'd like to just say, in general, when we think about an overall retirement plan, we think, and like we talked about in the beginning of the show, estate and legacy planning, how things are passed on to our heirs, our family is so important, and the tax efficiencies of our estate plan. Then, of course, there's income planning, there are investments and our investment strategy, and there's certainly health care planning that needs to be done. But the tax planning is really encompasses and infiltrates all aspects of a retirement plan.
Sure.
So when you think of a holistic retirement plan, you have to consider the tax strategy inside of the plan, because it literally taxes really, infiltrate or get involved in all aspects, whether it be the estate plan, whether it be healthcare, even with IRMA and income related Medicare adjustments, even tax implications get involved in IRMA and Medicare. Of course, investments and obviously income. So taxes are a big part of your overall retirement strategy. And we just really can't emphasize that enough. And we just want our listeners to know, if they would like a second opinion on their tax planning, like I say, with the tools we have available today, there really are, brilliant tools, and we're able to really pinpoint exactly what opportunities are there for our listeners. So if you're listening and you'd like to get a second opinion on your tax strategy for 2025 before the year closes, please call our office, 504-828-2171, or go online at crescentcityretirement.com.
All right. Thanks so much, Anthony. Great show. A lot of great tips. We packed a lot into today's show. Listeners and viewers, thanks for tuning in. That does it for today's episode of Wealth Builders with our host, Anthony Cangemi.